Hello, ladies and gentlemen. My name is Aspa Palimeri, and I'm the country manager for Mastercard for the Greece, Cyprus, and Malta. I'm very happy today because I think we have a really interesting subject to discuss. And for this one, I've actually asked Jesse McWaters to help us and give us all the insights. Jesse is actually the Global Public Policy Strategy head for digital issues. He is responsible to make it a bit simpler, Jesse, and make everybody understand. He is actually responsible for developing thought leadership on how issues such as artificial intelligence or blockchain or digital currencies could impact the strategic policy and regulatory landscape of the payments industry for the medium and the long term. Prior to joining us, Jesse served as financial innovation lead for the World Economic Forum. He has presented his insights in numerous financial institutions, among which the European Parliament and, of course, the IMF. He's also a very frequent media commentator on fintech, having been featured on CNBC and quoted in the Financial Times, the Wall Street Journal, and Bloomberg. So, after this intro, Jesse, thank you so much for accepting my invitation.
Thank you so much for having me.
It's a long one, but I think it makes sense because it helps everybody understand who is actually providing the insights in a really interesting subject that I have to say. So we're going to talk about digital currencies and blockchain, that is the underlying technology, which is actually a subject that has been quite a hot topic for the last few years. It has also created a lot, I would say, of controversy. Usually when we get into discussions, you will find very close friends of the subject, but also fierce enemies. And I think what would really make sense to kick off this discussion together today is to get from you those latest trends and the hype that we've seen in the last few months, even bigger hype, the key developments, and what you think is actually shaping this area going forward.
Absolutely. So I think the first and I think the most important thing to recognize about the digital currency and the crypto asset space is just the remarkable pace and the remarkable scope of innovation that we're seeing. So you see crypto assets really kicked off in this mysterious event, the publication of the Bitcoin white paper by this anonymous individual going under the name of Satoshi Nakamoto. It initially presents itself and is discussed as a type of payment system. But ultimately, it turns out not to be particularly effective in serving, the type of classical retail or business-to-business payments use cases that we're really familiar with. The throughput is too low, the energy costs a little bit too high. But nonetheless, the underlying technology as well as Bitcoin itself proved to be a foundation for more innovation, more exploration. You start to see other crypto assets like Ethereum develop, and you really start to see this innovation take off. And so over the last few years, we've seen increasingly crypto assets used as a vehicle for capital formation around some pretty exciting ideas. I think one of the most interesting of these is a sort of a category that's sometimes called Web 3.0. Basically, the idea of blockchain and crypto assets being used to create a type of decentralized next generation of the web. So think decentralized cloud service providers, decentralized messaging platforms, and social platforms, all created using this underlying technology of blockchain and able to transfer value using the crypto assets that run on top of those blockchain rails. At the same time, we've also seen over the last couple of years the creation of what gets sometimes called the DeFi, or decentralized finance ecosystem. And basically, this is a set of efforts designed to create an entirely parallel financial system where individuals can loan out their crypto, generate interest from it, and you're seeing the rise of decentralized exchanges, decentralized lending platforms, flash loans, all kinds of weird and wild stuff. And then most recently, and perhaps most interestingly to some of our viewers, non-fungible tokens or NFTs. You're seeing crypto assets enter into the creative realm, creating opportunities for new monetization of royalties, new types of creative communities forming. And I think that at the core of all of this, we really see a lot of creativity, a lot of innovation, and some pretty exciting ideas about how our notion of money and our notion of value transfer might be transformed and continue to be transformed in the years to come.
So I guess with all of that you've shared, it comes, I guess, as no surprise that governments are actually trying to set foot in this area and to strengthen their current role. And from what I've seen, this is happening most probably in two ways. The one is trying to regulate the private link to crypto assets on the one side, and on the other side, they seem to be working on creating their own digital money, what we tend to call CBDCs or central bank digital currencies. Actually, trying to prepare for this one today, I was looking into data that is coming from the Bank of International Settlements, where I saw these amazing percentages. 86% of banks, central banks globally, are actually being seen to engage in some kind of research with the aim to create a digital money of their own, and the 60% is already practically experimenting in this. So I would like to understand what has fueled this very rapid increase in their interest in CBDCs, and how do you think this is going to evolve? Is it going to stay very high in, let's say, the near future, the next 2 or 3 years?
Yeah, I think you're absolutely right to think about this as a two-pronged approach. On one hand, regulation driven by governments, and on the other hand, innovation, particularly driven by central banks, thinking about how they can play an active role in driving the future of payments and the future of finance from within their own remits. So first, let's talk about regulation. I think it's no surprise that any type of new financial asset inevitably finds itself under regulatory purview. And in most countries, what we've seen is regulators looking to take a really balanced approach. On one hand, giving the room that's necessary to enable new innovations to sort of start to test and learn. And on the other hand, looking to protect the broader financial system. And so even in the very early days of Bitcoin, you saw a lot of focus by governments on anti-money laundering and know your client regulations, trying to make sure that these kind of dark marketplaces that were popping up like Silk Road were under control, and that people weren't using these new innovations to fund or transfer, fund illegitimate enterprises or transfer in illegitimate gains. And I think we will continue to and should expect to continue to see an ongoing and continued focus in those areas. Simultaneously, I talked about the fact that crypto assets are getting used to enable new forms of capital formation. And so, unsurprisingly, this has created a lot of important and interesting questions about what constitutes a security and what type of regulations should exist to protect investors who might be considering buying a new token in the somewhat similar way that you might buy a newly IPO'd stock, and ensuring, again, that there's a level playing field here between these different types of assets that are emerging. And then most recently, I think you're starting to see an increased focus on that ecosystem of DeFi, or decentralized finance, that I talked about. We're seeing now the creation of credit predicated on crypto assets. We're seeing new types of interconnections between crypto platforms emerge. And inevitably that comes with a level of systemic risk. And so I think you're seeing folks increasingly focus on that. And then I think the area that is perhaps the most important right now, and the area in which there is the most work being done, is around so-called stablecoins. So it'll be no surprise to most of our viewers that crypto assets are extraordinarily volatile. They move around a lot, and that makes them problematic from a payments perspective. And so you've seen over the last 3 years or so the emergence of these assets called stablecoins. They're assets designed to track the value of usually a fiat currency, most commonly the US dollar, but occasionally the euro and other forms of value. And what we see is that they started out as getting used by as a type of settlement vehicle. So if you wanted to sell your Bitcoins, but you didn't want to have to go straight out to the banking system, or if you wanted to trade one asset for another, you might use a stable coin as a reference or as a settlement vehicle. But increasingly, There's a lot of discussion and exploration, most notably with Circle's USDC stablecoin, and with the formerly Libra, now Diem Foundation's proposed stablecoin project, that would envision this being used as a common mechanism for either B2B or retail payments. And honestly, that type of global new payment network built on a blockchain caught the attention of a lot of regulators. And so now there's a lot of focused work being done thinking about what would it take for a large scale, used by the average person stablecoin to be properly regulated, to provide the right level of stability, consumer protection, regulatory frameworks to ensure that AML and KYC compliance was in place. These are all things that I think are really important, and we actually see here that Europe is emerging as very much a leader with their MiCA, markets in crypto assets legislation currently being considered, really looking to set out frameworks for what would constitute a gold standard in stablecoins that would be really an acceptable and well-regulated form of payment. And we think that's a really interesting area, and one where we really encourage the work that's being done by regulators to clarify what constitutes good practice in this space. At the same time, you're seeing central banks looking to get into the action on this. They've looked at these technologies and they're saying, well, maybe we could play a new role bringing, our paper and metal currencies into the future. And so you see them exploring these central bank digital currencies. And I think, though, it's really important for us to recognize that while, the vast majority of central banks are now exploring CBDCs, that doesn't mean that every CBDC is the same. Central bank digital currencies, or CBDCs, are getting explored for a wide range of different policy reasons. In some cases, you look at the Riksbank in Sweden, because there is a real need to replace the underlying store of value as perceived by the central bank. Cash has largely gone away in that economy, and they feel there's a need for the central bank to continue to provide access to a form of money that's more fit to the way that people want to transact. In other areas, you're seeing exploration around how the central bank might add new bells and whistles, if you will, in terms of the capabilities that the money could have. And in some areas, you're seeing, a more policy-centric set of goals, really looking to reshape the payments landscape or drive new capabilities in terms of things like encouraging new forms of payment innovation. And so I'll stop here, but happy to dig deeper into central bank digital currencies.
I think I will give you that opportunity probably by saying the following. Up until recently, I think that what we have seen is that there's a lot of action more from what we would call new entrants in the field, in the payment industry, rather than the incumbents. Nevertheless, Mastercard, that is surely a very well-established company, is getting its foot, if you want, in the space. And I would like for you to help us understand what can we do, how can we take part in this ecosystem, and why we're doing it. Why are we doing it? Because we believe we are adding value. In what ways?
Well, I think that Mastercard has been committed really since its inception to being at the cutting edge of payments innovation and really supporting our ecosystem members, that being merchants, financial institutions, fintechs, and governments, in driving the agenda of payments modernization. And so while you haven't necessarily seen Mastercard, issuing our own crypto asset, we've been really active in this space for a long time from a research perspective. Mastercard is actually one of the leading holders of blockchain patents, with 89 patents granted globally and an additional 285 pending. We've, explored and tinkered around with creating our own blockchain. And we've been extending our reach out into the crypto asset universe, providing support for holders of crypto asset value. And so we have and have had for some time a crypto card program, as it's called, that allows folks to, at more or less any merchant show up and spend crypto assets that they, in their country of residence, are allowed to hold. And that might mean that you decide that you want to, spend some of your Bitcoin, and you want to be able to use your Mastercard, credit card, or debit card in order to do that. We've created a system where that value can be liquidated at the point of holding and moved through our rails as fiat. At the same time, some of our viewers might have seen a very exciting announcement that we made just a few months ago, that Mastercard is now exploring the actual ability to move crypto assets on our network. And so functionally, that would mean is that if I had a crypto asset and you were a merchant that wanted to accept payment in that crypto asset, those funds could flow through the Mastercard network in exactly the same way as fiat money flows through that network today. And I think that's a really interesting and exciting way in which Mastercard is looking to embrace the underlying technology of blockchain and some of the innovation that's happening within these crypto assets. And at the same time, really looking to prepare our ecosystem members, the fintechs and the financial institutions that we work with, as well as the merchants, to preparing them for this new world, really preparing ourselves to create seamless experiences for them in the ability to deliver both traditional forms of payment as well as new forms of payment. And of course, we haven't forgotten about governments themselves. We're active participants in dialogues around the appropriate regulation of crypto assets, and we're actively looking to help central banks in their exploration of central bank digital currencies. And so last September, we announced the creation of our CBDC testing platform. Some folks call it our CBDC Sandbox, which is really about creating an environment where central banks and their potential partners can work together on exploring what type of central bank digital currency is a best fit for them. Because while I think there's an enormous amount of excitement right now about CBDCs, it's critical to remember that a CBDC is not a panacea. It's not necessarily the best fit for every country, and it's not necessarily the best fit for every set of policy uses. And even if you do decide that a CBDC is necessarily the best path forward for your economy, as some economies doubtlessly will, figuring out the right way to structure it in order to achieve the policy goals that you're looking for, the right way to bring partners from the private and the public sector together, are all really important. The last thing that I'll say here, though, and I think it's in some ways the most important thing, is that while Mastercard is excited to be an enabler of innovation and to deliver innovation ourselves in this space, all of our work is governed by a core set of principles. We will only ever work on crypto asset and CBDC innovations where they are, one, entirely in compliance with local and international laws. And so we've seen, for example, some areas which have decided that they want to take a fairly hard line on crypto assets, banning them almost entirely from the jurisdictions. And so we'll obviously not be looking to deliver crypto asset solutions in those sorts of environments. And secondly, absolutely critical that consumer protections are in place. We want to make sure that people are able to have safe experiences. We believe that trust sits absolutely at the center of the consumer payments experience, and that it's critical to maintain trust and stability for all parties. And then finally, it's the actual stability of that asset. So there are some crypto assets today that simply remain too volatile to be effective mechanisms for payments. So those that are really proving to be most interesting, at least at the moment, are those, emerging well-regulated stablecoins that are able to maintain a consistent value. And those are likely to be the first ones that we'll explore enabling on our network and really starting to create a suite of solutions around.
That makes sense, Jess. And actually, being in Mastercard for a number of years now, I think the principles that you talked about are actually principles that are governing more or less all the work that we do in payments. So that does not really change in this case. And I think we're living in an ever-evolving industry, which means we never have a boring day. But at the same time, I think we sometimes feel really challenged to navigate through new territories all the time. And if we feel that way, I'm sure that our members of our audience feel that even more. So I think after all that we've discussed here today, what I would like for you to do is to try to help us keep in our mind two maximum, I would say, two key insights, or if you want, key conclusions from your side on how we should think about this new territory and what is really important about it, on how it's going to evolve.
Absolutely. So I think there are two things that I'll say. The first is, don't think of these innovations as a monolith. Be open to nuance. And so I know when I have conversations in this space, I'll talk to some people, and you said the great advocates and the great opponents. Some people will say, well, crypto assets, it's nothing but money laundering and crime. And other people will say, well, the only way forward is crypto assets. In the future, everything will run on the blockchain. And I think that both of those are probably overly simplistic and overly reductive approaches. I think what we really need to think about here is always to keep in mind what is the problem that we're trying to solve, and how can a range of technologies, including the rapid emergence of new capabilities around crypto assets, aid us in meeting those goals. And so I think when we look at crypto assets, I think there's a real sense in which, while some people are opposed to increased regulation around them, and feel sometimes that is as an anathema to the crypto libertarian ethos that started at its founding. In my view, the best way of really making the innovations that are encapsulated in these systems accessible and user-friendly to end users is to place appropriate regulatory frameworks around them so that they can be safe, so that they can be stable, and so that we can ensure that the ability of bad actors to use them is limited. And I think exactly the same narrative applies within the world of central bank digital currencies. We shouldn't have a central bank digital currency just because other countries are exploring one. Countries should have a strong rationale for what it is that they're looking to achieve and why a central bank digital currency is the right tool for the job. And then think about how really to work on actually delivering on those policy goals. It's not about just creating one for the sake of it. It's about achieving a specific set of policy goals and figuring out the right mix of public and private to deliver that. And then the second thing that I'll say is that I think the most important thing in this space for all actors is to think about the principles that I outlined before about establishing strong compliance and stability regimes, about ensuring that strong consumer protections are in place, something that requires us to think a little bit differently in the realm of crypto assets, where you can actually lose your keys in a way that you can't in a traditional banking system, creating some real challenges in terms of ensuring that users are safeguarded against even when they themselves might make a mistake. And then how do we deliver stability in this space? It's not to say that volatility isn't useful in some crypto assets, particularly those that increasingly seem to resemble investment assets. But when you want to engage in payments, you need to know that the assets underlying that are stable. And so, and just to wrap that up, it's about, on one hand, making sure that you recognize the nuance in this space. It's not a monolith. Keeping the actual objectives that you have in mind, the type of outcomes that you want to drive for the users of these financial products. And then at the same time, keeping at a bedrock this view of principles, that at the end of the day, we're looking for safe, stable financial systems that, serve that serve the interests of their users. And that we have to keep that in mind every step of the way.
And I think, Jess, with that, I'll probably try to go back in the title of our conversation. And my understanding is that there is a lot of buzz, and it has been a clear hype. There is clear potential because it brings a new capability, if you want. But the pitfall would be to look at it as the only solution, because there are many solutions, and it is only, my understanding is, one lever in the hands of government, but also the private sector. And I guess the only way to ensure that we optimize what we can do with it is engage in more conversations and engage in, testing, if you want, exactly as we're doing through our testing platform or Sandbox, as you called it. I think it was a first introduction, if you want. I think a very, very rich in content. From my own experience, I would say that it takes much more than 1, 2, or 3 to start getting in the field. And of course, I invite the audience that is really interested in it to come back to us and have more in-depth conversations. I want to really thank you for being with us today and exploring a new and very, very interesting area, I believe.
Thank you so much. It was a great pleasure.
For us too. Thanks.